Hey everyone, we're here with Tom Basso today. So some of you guys know that I'll be off camera for a little bit. Maybe I'll be on next week, but the week after that, I'll be away for a couple weeks. So I wanted to bring on some special guests of mine, people I've had on over the years, people that I've looked up to. Tom's absolutely one of those guys. Definitely learned a lot about risk management, systematic trading, and most importantly, how to calm down and understand what's going on in the markets without overreacting. So, how are you doing today, Tom? It's always good to
Doing
see you.
doing great, Jason.
Good, good. It's always good to see you. I'm always excited to just have these conversations. And for you guys who want a bunch of good educational research, Enjoy the Ride, which is Tom's website, has a ton of great educational research for you guys to check out, not to mention All Weather Trader book, books on position sizing. It's pretty endless. So, definitely make sure to check out Tom's page and get an understanding for what this guy does because they call him Mr. Serenity for a reason, and he absolutely is Mr. Serenity. So, Tom, first off, today we're mainly talking because the market was going down and everybody's making irrational decisions. Just I got to get out. It's a bear market. It's a bull market. It's the end of the world. What do you think of when the market is kind of turning down and going against you in any of your positions?
I kind of remind myself that the market will do what the market will do, and I just go with it. If it's going down, I want to be short. If it's going up, I want to be long. If it's going sideways, I kind of try to stay out of trouble. And you're going to see all three of those conditions, up, down, and sideways. And to not have a complete strategy that would at least understand and deal with all three seems to me to be a little short-sighted because you know you're going to get all three over your lifetime. And I've certainly, since I've been trading 50 years, I've certainly seen lots of ups and downs and sideways. One of the reasons I trade multiple strategies is because some are going to be a little bit quicker to deal with a quick turn. Others are going to be more long term and stay with the trend. Some are going to be pick up, credit spreads in a sideways. There's different strategies that you might employ for different types of conditions. So why not try to have multiple strategies that are designated towards dealing with various conditions? So like right now, I'm on the stock market generally. I'm long some of the indexes. I'm short the Dow futures. So it's kind of a mixed bag. And that's just been recent that I've turned to the upside. It was pretty much down for the previous 2, 3 weeks. So I caught most of the down and have already sort of reversed quite a bit of it. And who knows whether it'll go up or down from here? I have no clue. I just go with it.
So do you care if the market goes up, down, or sideways? That's the other question I want to ask.
No,
Does it mean anything to you?
no,
No, and
not in
you'll
trading. In trading, like macroeconomically speaking, I like to think of myself as an amateur behavioral economics guy. I like to try to listen to what the Fed says and what the president says and what Congress or any person out there, some economist says. And I try to ask myself, does that make sense from a standpoint of how human beings will react to whatever that policy would be? So, for example, one of the simplest and easiest examples in behavioral economics over time is the Laffer curve. When the CBO, the Congressional Budget Office, takes a increase in tax rates that is proposed, it automatically does the math and said, well, we got this much coming in and we're going to increase the tax rates by that much. And therefore, we're going to have this much more money coming into the government. And usually the opposite occurs. Usually people start avoiding taxes as taxes go up. So all of a sudden government revenues start drying up. You got an economy that gets choked off. So you got less growth. So therefore less taxes to collect on the growth. And if you do the opposite, you drop tax rates like they did during Reagan or first Trump term. What did you get? You got increased government revenues, and that's not what the government, but a congressional budget office would predict. But if you think about it from the standpoint of behavior, it makes sense because growth happens. People are more willing to pay a lower rate. So they're not spending a lot of time trying to duck around taxes. And so therefore government revenues go up. And that's a demonstrable, repeatable thing that's happened in the last 40, 50 years. So I don't know. Why does the Congressional Budget Office continue to cling to the obvious error of their ways? But they do. And so I look at things from that standpoint as a citizen, as a taxpayer, as a person who has to vote every now and again. But from a trading standpoint, it's all about price. Everybody thinking whatever they're going to think is putting money on the line to buy or sell. They're putting selling pressure one day, they're putting buying pressure the other day. Whoever's winning that battle and forcing the market has a lot more money than I do. And my job is just as a trader to read which way it's leaning and go with it and not worry too much about why. I might know why it went that way like a week or two from now, and I can look back at the news and say, oh, I guess everybody was, skittish about tariffs or whatever. Um, if the market had gone up when the tariffs were announced, then you'd say, well, everybody was bullish about tariffs. it's it really the only thing that matters is whether I'm long or short and the market matches that direction. And if you make it more complicated than that, you're just stressing yourself out.
Exactly. And that's why I wanted to ask that question. Tom and I are very similar, and I didn't, create this on my own. I learned from the giants like Tom and Jerry Parker and so on, the ideas that you read about in the Market Wizards books and then into the turtle trading books and so on. Just understanding that it doesn't really matter. We're always just going to kind of follow price, and it also helps you to, clear your mind and kind of be in a more meditative state as a trader. So,
Mhm.
how did you kind of come up with this strategy, Tom? Like, being able to be Mr. Serenity. Were you ever not Mr. Serenity? Were
Oh
you a
yeah.
guy that was hot-headed, or revenge trading or any of these things? Do you have any of
No,
those stories?
when I was very caffeinated in my early probably 20s or late 20s, and I was starting up our first money management firm, I was definitely running very fast. Go through a pot of coffee a day. I was wired. It was, something that as a 20-something-year-old, I had the energy to keep up with. There's no way I could have done like today what I did back in my 20s. It's just physically impossible. Um, so what I realized through a lot of different awareness exercises was that perhaps the coffee or caffeine and just the way I was approaching just life in general, not just trading, was making me have a tendency to be a lot more unaware of the various mental states I was going through. So you could swing higher or lower or get frustrated, angry. A lot of different emotions could come in and seat in your being. And so I decided as an experiment on one of my trips, I would just go decaf the whole trip. So I was gone for about a week or so, and I had the typical headache on the first day, but I put up with it. Maybe took a Tylenol or something, and got through that day. And then next day, man, this peace came over me. It was strange. I thought, wow, I didn't take any drugs to do this. This is weird. And that peace never went away. It just stayed. So when I went back home, I laid off the caffeine and was decaffeinated completely for a lot of years. And now I use it very carefully. Like in the morning, if I want to get started and I just want to have a cup of coffee in bed and just find out what's happening in the world overnight, I'll do that and just relax in a relaxing environment. So I'm having the caffeine and relaxing at the same time. But once I get into the office and I'm actually checking my overnights, and I was working with Grok this morning on some program that I'm fooling around with, that type of thing, I don't need extra caffeine. That's enough stimulation. So I just try to relax through the day, and I'm much more aware then of when I am frustrated, and I try to take that frustration and say to myself, look, that's not going to help anything. How about just going to Mr. Serenity mode and relaxing and realizing that, the guys that were supposed to show up as contractors this morning, somewhere between 8 to 12, it's now 11:30, they're still not here. That's kind of par for the course, and you just roll with it and just keep going. And they'll show up sooner or later, or they're going to get a phone call asking where they are and whatever, you know.
Yeah, but I love that because I think it's all of this stuff when I talk about, traders kind of like, whatever, what are we picking? What are we buying? And really it's like this is actually the secrets of trading here, And when I was a young trader, I thought the same thing, why won't these guys just tell me the secrets? Like they're talking about being meditative and calming
Yeah.
down and position sizing and all this boring stuff. And I just want to know whether I should buy Apple or this one or whatever, and then the years go by and you're like, no, that was actually the secrets were all right there. Not to mention, I was talking to you as before we got on, where you were talking about what you were going through. I was mentioning like a pipe blew up and like I saw water coming down on me just before we got on, and this is just kind of how life goes. And I think when you just kind of understand that, let life move the way it does, it just helps you with markets. It helps you with everything because really
Yeah.
it's, you can't control it. You just can't control
It's
it.
really life. As I told you when we were getting on, I had an irrigation leak spring from a bunch of landscapers that decided to move a small snake fence, and they used a very sharpened PVC pipe and they pounded it into the ground right into one of my headers. So all my deciduous plants in the yard were looking a little peaked. And I thought, that's strange. What's going on? I'm wandering around. I started up the zone and I heard this big gurgling over in the corner of the yard. I went over and I was making a little lake there. Oh, crap. So this morning when I got up, all of a sudden I was on my knees repairing an irrigation header. And then I got cleaned up for this.
And it helps you for, I mean, really, that's an outlier, like that's how things work. Like the market's going up and everybody's excited. They're partying like it's 1999. And then you get this crash scenario, and everybody's like, it's the end of the world. And for people like us, it's more of, oh, my stops got hit. Like that's
Yeah.
kind of just the way it is. You have the right position sizing. So how did you kind of get into position sizing properly? Because I think
Tell you
everybody
what, I
has
have
an
to credit
interesting.
Larry Height.
Mhm.
Larry Height in the first Market Wizards book had a statement in his chapter that said, we try to, he was running Mint Investments, one of our major competitors, and that does, he was more of a billion-dollar manager when we were like little guys. I was more a compatriot with the Jerry Parker group, the Turtles and all that. I competed against them. They're coming up in the industry, but uh, yeah, Larry was a little ahead of us and made the first Market Wizards book, and he made a statement that he talked about a lot about gambling and bet sizes. And he thinks in terms of that because he did do some gambling. He thinks in terms of gambles. And so he made a statement that he tries to make every trade he puts on the same bet size as any other one. Now, I started thinking about that. I'm an engineer by background. I got a lot of math and computer science and things in my coursework to be a chemical engineer. So I'm thinking about bet sizes and I'm thinking about, percent of equity. If you take and you make a certain dollar bet, but the instrument that you're trading in is very different, then you're going to have the more volatile issues in your portfolio driving your portfolio. It's not going to be truly diversified. And I knew that Mint was a very, very diversified manager. So I puzzled over that a little bit and I said, how about if I took the amount of risk? A bet is the amount you're willing to lose. And he did articulate that in the chapter as well. If you're looking at the amount you're thinking of losing, it's where you're getting in to where is your stop loss. So you got a nice little definable per unit dollar loss that you can take on a position per unit. So that in a futures sense would be per contract. Stock sense would be per share. Once you know that, then you ask the question, How many shares should I buy? How many futures contracts should I buy? And I limit this amount of risk, say on a cocoa contract or, whatever, pick it, the natural gas. This is my stop, let's say, according to the price charts or the indicators I'm using. And then I say, okay, now that I know how many dollars I could lose per contract, how many contracts? Well, I should do 8, I should do 14, I should do 25, whatever the number is. That equals 0.35% of my total equity is that loss. And so it sets my position. So if I'm comparing I don't know, a Dow futures contract with a ultra bond treasury contract, they're the same bet size, which is exactly what Larry talked about in his book in the chapter on market wizards. And then I took it a step further. I actually applied volatility as measured by ATR, or average true range. And you can look the formulas up on that in investopedia.com. I took that and said, I don't want my volatility per position anything more than about 0.2% of equity for an initial position size. And so I do both calculations, and then I ask myself, which gives me the smallest answer? Because the smaller answer would be less stressful. And that's how I did my position sizing. The whole book on gets into God, not only risk as a percent of equity, volatility as a percent of equity, margin as a percent of equity, total portfolio as a risk and volatility as a percent of equity. And if you limit all of those, you've really reined in too much of you've reined in quite a bit of the risk of ruin, the stress, the things that traders go through when they put on a NVIDIA stock position and NVIDIA goes nuts up or down and it becomes your portfolio. You have one position and you have like 9 other things that don't count. I like to have a more diversified portfolio where everything counts, and I think this is a good way to do it.
That's perfect because that question just came up in the chat, which is, how do you diversify through a managed portfolio, and that's exactly it. And this is all the stuff that like this is what makes you a great trader, which is understanding this stuff because when you're sitting there and you think trading is just a bunch of people who are right a lot, like that's not true. And so like I'm sure you've done the back test, I post the back test all the time of high win rate systems that just blow up and lose money. Okay, they could win 90% of the time, and then your 10th trade could lose, everything. And then also you look at the low percent win rate systems. So you ended up going towards the more lower percent win rate, but great returns, which is trend following. And
Mm-hmm.
so how did you navigate towards that style of trading? Did you always like the more long-term style of trading, or did you like something else at first?
Yeah, in the early going, I was actually a chemical engineer, so I was designing chemical plants and didn't have a whole lot of time, certainly during the day when the trading days open. So I always had to do all my work at the end of the day, which is to this day still where I do most of my trading work after the market's closed. So I would go home and I'd pull some data and I would look at charts and what led me to trend following and back then in the 1970s, I didn't even know there was such a thing. I never knew that the term was called trend following. I don't even know if anybody really called it that back then. I don't remember that being a label, but I put some charts, point and figure charts actually, down on the floor, and I sat up there on my sofa, and I was looking at about 10 of these charts strewn all over my carpeting. And I noticed you could really see a lot of very big moves up or down. And I knew which chart was which. That was live hogs, and this is corn, and that's a stock market chart, and whatever. And I said, boy, if you could just pick up that one and this one and that one over there, man, that'd be a lot of money with those like 5 or 6 trades that I'm looking at. And I'm looking at years of history on these charts. And so then I started thinking, well, what would be the common thread? So I took all those and kind of circled them and put them on the coffee table and tried to look at what had happened before each one of these. Is there anything that's a common thread? And I ended up evolving to a strategy that was basically a breakout, somewhat long-term strategy so that I could make sure I'd pick up every one of those big runs. And that's kind of where I went. Then once I added in the position sizing to modify how much my drawdowns were going to kill me, then things got a lot easier because my drawdowns were a little bit more tame. My returns still would catch those big runners so that I could, enjoy that ride. And it seemed to evolve. And now I'm sitting in retirement and all I'm doing is running multiple strategies, long term. I'm diversified by market, I'm diversified by indicator, I'm diversified by time period. And so, whatever day I look at the screen, there's green and red every day on the screen. There's never a day that it's all green. There's never a day that it's all red. It's always a combination. And so, you can, if you tell me and describe the type of day that any one market is doing, and I look at which position I'm in, I can tell you right away which strategies are going to be switching the other way tomorrow, which strategies probably stay with where we are, what my position sizing will probably do if it's getting out of whack. And so it's kind of like I understand the math and the strategies, and I design those to deal with various conditions so that no matter what happens, it seems like I've got a plan somewhere along those strategies to take advantage of it and therefore offset some of the losses that may come from some of the other strategies. And so that gives you that red and green kind of thing on your screen. And as long as the total adds up to green, I'm happy. We're making progress. That's kind of the goal, is to see if I could squeeze that to pretty much be green every day. I haven't gotten there yet, but perhaps I'm closer than I was when I started the mission. So that's kind of what I'm intrigued by trying to do. That's my own personal brain teaser.
Well, one you talked about, you called it something that a term I still use to this day, which is filling in the potholes.
Oh
And
yeah.
like I love the way you said that because it's something I tell everybody all the time whenever I say it. I stole that straight from you, but it's actually very true. Like if you have a trend system, and there's periods of time where trend is going to underperform and mean reversion is going to outperform. But if you run both, now you're in a period of time where now you filled in the potholes. Now at certain times the trend system might be making or the trend system might be making all the money. Other times the mean reversion system might be making money. I mean, it's a great way to trade, and you really outline it well in your book, The All Weather Trader. That's a great book for anybody who hasn't read it or heard about it. It's a good one to pick up. So
And
another one I want to go ahead.
I on the filling the potholes, I credit Lawrence Bensdorp is the one that started that term. And his book, the most recent one on multiple systems trading, is one of the best I've seen, easy to understand, and goes through the logic behind multiple systems trading. And I love that book. I've recommended it to a lot of people, and he used the term filling the potholes, and I stole it from him.
Interesting.
So there's a lot of stealing the
I read
terms
that. I don't
from it.
remember him saying that, but it's probably just because I heard you say it actually. So that might be the difference. But no, that's awesome. And so, another thing to talk about, before we go, so we'll probably leave in about 10 minutes from now. But just so, everybody can kind of see in practice, what do I mean by Tom is Mr. Serenity? So, we were talking, I think this is the 90s. I think we're talking about the oil trade. And so you come into the office and you can explain it much better than me. So basically explain what you were going through at that time as a fund manager, dealing with a big situation at the moment.
Yeah, so the computer programs didn't work that afternoon. Something that we did to it must have messed up. So we're supposed to send the orders in by about 3 o'clock in the afternoon, and it's not happening. So 3 o'clock rolls through. The trader is getting ready to leave. I said, just go ahead and leave. Assistant traders there backing me up. I'm registered, so I can send the orders. And the computer programmers are panicking, trying to find the error. And so 5 o'clock, 6 o'clock rolls around, still aren't, we're getting hungry, we're getting tired, we can't find the error. I finally said, hey, I'm going to go across the street and get some Chinese, bring back, we're going to take a break, we'll attack it again. And son of a gun, we took the break. Our minds cleared. The stress was gone. Our tummies were nicely full, and we found the error, fixed it. The orders went. So as I'm walking out, I decide to look at the screen and see how our overnights are doing. And I look, and crude oil, we're long, and it closed at 32. I still remember $32 a barrel, and it's at 40. And I'm thinking, oh my gosh, we're making a ton of money. This is going to be a good day tomorrow. So I wake up, and it turns out it was going up because we were invading Iraq the first time. This is H.W. Bush, and so crude oil had jumped all the way up to 40. I wake up the next morning and I walk in, and our head trader tells me oil went from 40 to 22 overnight. We're now out of oil, and we can't even afford to put any short sells on most of the accounts because the risk is too high. The accounts don't have enough money in them to tolerate the risk limit. So we're pretty much flat oil at this point, waiting for our next signal. And so the total portfolios, and this was like $5-6 million worth of losses for all of the collective clients of Trendstat Capital, and it was something like a 5-6% loss for the day. It was pretty significant. And and I fielded lots of phone calls and the usual. And I said, it's just part of the strategy, and these things come along every time again. You just got to keep doing what we're doing. Within about 2-3 months, we were making new highs again. So,
See, that's exactly like that. It's a great story, and people always want to hear about how you did it in practice, and that to me is just what really illustrates one how you do this. Like
yeah,
you can't panic in those situations and go it's the end of the world, or try to double down and buy it back lower, or any of those things. You just continue to run your strategy the best you can going forward. So Tom, I'd love to ask you, so a couple people were asking, do you use technical analysis every day? Are you looking at the price action? And I know that some trend guys don't exactly call it technical analysis, but do you use price action trading every day, or do you use any sort of fundamental analysis? Somebody asked it in the chat.
I use zero fundamentals at this point. And there's been times in the past when I was trading more stocks and at a previous firm, investment advisory firm, that I helped found back in like 1980, I think it was. We did use some fundamentals, mostly in data, though. We used them to screen stocks using databases. So it was kind of a technical way of using fundamentals, if you want to think of it that way. But currently, I look at prices, and I like to think of price movement as having a sort of high of a range of normal noise and a low. So anything in between sort of the high part of a range and the low part of the range, anything in the middle, that's where the battle every day goes on between buyers and sellers. And I want to ignore that. What I want to try to see is where are the buyers winning the battle and where are they losing the battle. So I measure using things like Donchens, Keltners, Bollingers. You can look all the formulas for all of those up on Investopedia.com. And most broker platforms will have those as standard indicators. So you can put them right over top of your price charts. One of the combinations I love is to take three things, Bollingers, Keltners, and Donchens, and put them all over top of each other, and then use the one that's closest using all the same time parameters, adjusting the times factors. If you study those indicators, you'll know what I mean. Get the lines to match up as closely as possible. Then just put your stops at the top for the buys, the bottom for the sells. Ignore the in between because that's just noise. And you got yourself a good long-term way of looking at trend following. And you've got three different indicators. The thing I like about that is, like, you get into something like the tariff crash or the COVID crash, for instance, where it happens very quickly. A Donchen, if you're going back, let's say 21 days, for example, the Donchen's not going to react for 21 days. Well, in 1 month of COVID crash, you've gone a long way down. Your stop's still way up there. But if you use things like Keltner's and Bollinger's going to use standard deviation. Keltner's going to use average true range. You're going to get more volatility, but you're also going to get a moving average trying to come down quickly to catch up to where the market is. So the mathematical advantages and disadvantages between these indicators sort of help each other out a little bit. If you take the one that's the closest, you probably have done a good job of measuring the current amount of noise and ignoring the noise. And then when it breaks out through your first indicator, you go long or go short.
No, and another way to look at that too is I'm pretty sure you did a video, was it with TrendSpider on this? Actually, like I think you did it and I think it's on Enjoy the Ride, your website too. So if you guys look that up, you can see where Tom actually uses all three of those indicators in a trading strategy, something that I've watched before as well.
There may be
I love it.
also a $29, pretty old at this point, video that I put on the website that you can rent and download and watch that I think is just on buy sell engines. So it
Nice.
talks about a lot of different ways of triggering. I call it a buy sell engine because an engine motor, moves the car. And I think a buy sell engine should move the trader, it should make you do something. So you should either buy or sell. And so I call them buy sell engines. And it could be things like a Keltner band and you're crossing the upper band. So your buy sell engine is saying, buy it. You're in an uptrend now, buy it. So it's an engine. And I think I did one whole video or webinar quite a number of years ago on that subject. So that might be useful. The
No,
book
for
also
sure.
covers some of that.
Yeah, definitely read the book. I know Michael Noss is in the chat, talking about it. Larry Williams said or Larry Thompson said he picked up the book. So thank you guys for checking in and hanging out with us. So Tom, just to end it off on a high note, something I always like to ask is what advice would you give to your younger self? There's a lot of people on here watching that are just learning how to trade. They're a little bit confused about the market still. What would you give them? What advice would you give even yourself at that point?
Hmm, that's a tough one. I think the first thing that and the easiest is to be careful with your position sizing. I mean, lately you got markets. If this is normal volatility from top to bottom, you look at some of the bars recently on the charts, they're twice, three, four times as much. You should probably be trading maybe a quarter of the position size that you were trading when markets were boring. So that's probably the most mathematically impactful thing you could do. And it doesn't require extensive mental analysis of yourself. I think the second thing that was probably the most useful in my trading career would be to improve awareness. And for me, it was trying to tune into myself and figure out whether I was being aware of what my mood was, whether it was I in a mental state that was useful for trading. In other words, if you came into the market every day and you said, I don't care whether it goes up or down, I have a plan for everything, I have a position sizing plan for everything, I'm trading a very diversified portfolio across lots of time periods, and I want to be in a agnostic opinion of the direction. I don't care if it's going up or down. I really don't. I'm not going to predict anything. I'm just going to read what's going on and go with it. And if you get out of that mental state and you're not aware of it, then you're off the tracks. You could be getting greedy. Oh man, I'm making a lot of money in NQs today. Maybe I'll take half the profit and take my wife out to dinner. No, that's greedy. You're going off the plantation. Quit doing that. Just stay balanced, stay even keeled, just run, just execute flawlessly. It's what I keep telling myself. Don't make an error, execute flawlessly. And if you can do that and stay in that mental state and be aware of when you go out of it, then that's going to help you a lot as a trader, no matter what kind of trader you are. Even if you're a guy like me that tends to have more computerization and you hit the button, hey, I'm the human guy that has to hit the button. I can override anything I want to do if my human mind wants to take me off the plantation into some kind of wacko mental framework. So I think the most useful thing to learn from that is as a young trader, try to figure out how you go through various mental swings and be aware of it. And then, secondarily, of course, do something about it by bringing yourself back into, on the track. And I think that would serve you well as a young trader.
Yeah, I think I always bring up keeping a journal as a trader, and people will ask me, "Hey, what does your journal look like?" And
Yeah,
they expect this crazy thing, and it's like it's a book that I write on. Like, am I in this type of mood today? Could I revenge trade today? Could I bypass my systems? Like, what is that's all I'm doing is checking in with myself, exactly like you said.
right.
So I think that's very significant and a great way to end it. And Tom, I just want to thank you so much for doing this. As always, I love seeing you, I love chatting with you, and I always learn so much hanging out with you. So thank you guys so much. Thank you guys so much for joining us. Tom, where can these guys find you?
Well, the website's enjoytheride.world, not .com. .com was taken, so I did world. And I have traders all over the world that talk to me, so it seems appropriate. On X.com is probably the largest area where I'm active is Basso, Basso underscore Tom is my handle there. And make sure you don't get an imposter. There's so many imposters out there trying to scam people these days on social media. I don't sell anything in direct messaging, and I'm not going to suggest a crypto or currency program for you. Um, so that's probably the other way to get a hold of me. And other than that, my email's tom@trendstat.com, which it has been for the last about 40 years. So you could always send me an email if you have a specific question that you want answered. I answer all my emails.
Well, thank you so much, Tom. Thanks everybody for joining us. And this is Tom Basso. We will post the replay at some point soon. All right, guys, take it easy.